Kingdom's Wealth and Wisdom, brought to you by Petra Worldwide. Here is Nathan Weaver.
Greetings and welcome to Kingdom's Wealth and Wisdom. I'm Nathan Weaver, founder and executive director of Petra Worldwide. When couples walk down the aisle and they merge their estates, they often believe they are stepping into a realm of unified financial advantage. Society preaches that marriage brings a tax bonus, a structural break to your liability. And for decades, if one spouse was a high earner and the other managed the home, the bonus was a statistical reality. But out in the modern marketplace, in today's society, where power couples are building dual income empires, that bonus often evaporates into a cold, hard financial reality known as the marriage penalty. Many high earners operate under the assumption that the tax code completely smoothed out this penalty years ago. Today, I'm going to look directly at the data to prove that high income earners, dual income households, that the marriage penalty is alive and well for you folks. And we'll talk about some quiet executing strategies you can do to help your family and your legacy. To understand how the IRS penalizes a legal partnership, you must understand the structure of the progressive tax system. Through the lower and middle income tiers, the tax code is perfectly symmetric. For single filers, the standard deduction of $16,100, and for married couples, it's exactly double, $32,200. The base tax brackets follow this exact 2-to-1 duplication all the way through 10, 12, 22, and 24% brackets. If one partner earns 200,000 and the other earns nothing, marriage provides a credible tax bonus by pulling down the higher earner's income into a lower tax bracket. But the moment you combine household incomes and they scale into the upper atmosphere, the systematic walls in that fortress crumble. Look at the top 37% bracket. A single filer doesn't hit that top rate until their individual annual income crosses $640,000. But if two single high income executives each make 600,000, neither of them hit that top tax bracket. Their separate incomes are capped at 35% tier. But if these two individuals marry and file a joint return, the IRS does not double the single threshold to $1.2 million. Instead, the married couple threshold for 37% tax bracket starts at $768,000. So now all of a sudden, $430,000 of combined income is instantly pushed into the highest tax bracket, costing the household thousands of dollars in an unforced, unregulated penalty.
Pastors and financial leaders, do you need expert accounting or tax help? Do you have payroll or 1099 questions? Do you need a ministry expert to help you acquire real estate for your next project? If the answer is yes, yes, and yes, visit petraworldwide.org. Petra Worldwide has been strengthening ministries to transform humanity since 2007. Visit petraworldwide.org or call 855-481-9095.
So this marriage penalty also hides in other areas of the tax code. Watch out for it in the net investment income tax, the S&P 500 capital gains tax, and the Roth IRA phase-outs. All of these areas have a similar pattern when you are married filing jointly as a high income earner. You can't manage a kingdom based on, sentiment. If you're going to marry, do the math and understand the impact that it's going to have on you and your financials. At Petra Worldwide, as your virtual CFO, we can certainly help you with that. We look forward to working with you. Go to our website, join us on KingLife, become part of the KingLife community. We'll look forward to seeing you soon.
Listen every day at 4 p.m. for Kingdom's Wealth and Wisdom, brought to you by Petra Worldwide, strengthening ministries to transform humanity. On the web at petraworldwide.org.